In my experience as a financial advisor, there are 4 types of investments I see time and time again amongst Australian retirees, each with their own pros and cons. So for this video, I'm going to talk through what you need to know about each, where I see most retirees putting their money in the market today, and be sure to follow to the end because I'll let you know my opinion on which ones typically make the most sense. Plus I'll share one investment I commonly see retirees making that almost always ends in disaster. Now, there are 4 types of investments I want to go through today, and starting at the top, listed shares or ASX listed shares. ASX just being the Australian Stock Exchange. So a listed share, at its most simple, means you're taking ownership in a company and that company's shares are publicly traded, which means you can trade them with anyone in Australia or around the world. And that is one of their biggest benefits. You can trade them every day. You will own a share of the profit and dividends of that company for as long as you hold those shares. These offer the potential for both income in the perspective of Australia in the form of dividends and the benefit of franking credits where those companies are paying tax in Australia. They also offer the potential for growth. So as you can imagine, investing into companies, you're investing because you expect that company to get bigger or to diversify or add new products or business lines or invest in the future. They're incredibly popular, and for one main reason is they're quite low cost. You can build a portfolio of 20 individual companies and only pay a small amount of brokerage, and in some cases you get free brokerage, which is something we'll discuss in another issue. In the case of shares, there's no management fee. It's up to you. You can trade these yourselves. You can engage an advisor or a broker or someone else to help, but in most cases you're not paying any additional fee outside of transaction costs. A couple of the drawbacks, they're incredibly volatile. So we saw during the pandemics, during the global financial crisis, the share market itself can fall as much as 40 to 50% during periods of stress. And companies, the risk of investing in a company is that it goes to zero. Many companies do go bankrupt, and in some cases they just change significantly. There's a lot of well-known companies that have fallen in value by 70 to 80%. You may never get that capital back. So that kind of leads to one of the other risks of these is they're incredibly difficult to do alone. If you're going to invest in ASX listed shares, you need to have research, you need to have frameworks, and you need to be very aware of what you're buying. This leads us to the second type of investment, and that's what's called a managed fund. Now, there's a few misconceptions about managed funds, which I'll delve a little bit into later. But essentially, in a managed fund, you're pooling assets together with other investors in the form of a trust, in this case, a unit trust, in which you get issued units, and each of those units gives you the right to ownership over a pool of underlying assets. So managed funds can be investing into ultimately anything. They could be investing into property, they could be investing into listed shares, they could be investing into bonds, infrastructure, any range of investments. One of the big benefits of investing in a managed fund is that they're professionally managed. That means you're able to access the skills of a team of professional investment managers that have, say, 30 or 40 employees in some cases. So you're getting that benefit of professional management. And probably more importantly, rather than having to buy 20 stocks to get diversification, or 20 shares. In the case of a managed fund, you can have anywhere from 30 or 40 individual investments to 100 different individual investments in there. So you get diversification in a single investment and in a single line or a single asset. Very difficult to replicate anywhere else. A couple of the drawbacks are that managed funds and professional management comes at a cost, which is called a management expense ratio. And similarly, because it's a unit trust, these structures don't pay tax themselves. So any income and capital gains that are realized via the active management of those investments is simply distributed to you and wherever you're invested, and then you will have to pay tax on what comes out the other end of that. There is one big misconception that managed funds are, say, less liquid than exchange traded funds. I always like to address this because a managed fund is as liquid as the investments that it holds. If you invested in a managed fund that holds unlisted, so direct property, it owns a building across the road, and a lot of people want their money out of that fund at the same time, well, there's a risk that they have to sell that building. If it's invested in listed shares like BHP and CBA, there is no liquidity problem. If you want your money back, you get your money back based on the unit price at the end of the day, and you're able to redeem that in the form of a form, or more recently using a platform as putting in a request to sell your investment. Now, moving from managed funds to exchange-traded funds, incredibly similar, but there are also quite a lot of differences. They're a similar unit trust structure, so they are called funds, but are actually structured as a trust. The difference being they're traded on the ASX. So your units in that trust or fund, you are now able to sell and buy that on the ASX. This means they have a net asset value, or in the case of ETFs, an INAV, which is a calculation of what the underlying investments are worth at any given time, which allows you to ensure that when you're buying or selling those, you're receiving a fair value based on the underlying investments that are in there. So if the shares have gone up 10%, the unit price of that exchange traded fund should also have gone up 10%. Now, similar to managed funds, they offer diversification in a single line, and they're incredibly cheap and easy to buy. Managed funds, historically, you need to complete a physical form or use a platform like Hub24, Colonial First State, Net Wealth, one of these options. Exchange traded funds, you literally just need the same broking system you have already in place. In a lot of cases, and the structure of ETFs is that most of them have to track an index, or they do track an index, which means a lot of them are index funds, and we'll cover this in another video, but an index fund is essentially something that tracks a benchmark like the S&P 500. So when they refer to the market every day on the news, if you're invested into an index fund that tracks the ASX 200, you're going to get the market return. So most of them are passively managed as opposed to active, and that gives them the benefit of being lower cost than actively managed funds. And another differentiation, which is related to the next asset type we're talking about, is that they are open-ended. So as new units are purchased in the ETF, new units are created. They go and buy all those shares and put them together as a new unit for each investor. This means that the assets in that can keep growing, increasing and decreasing over time, and importantly helps ensure that the share price stays in line with the underlying value of those assets. Now, the last one I'm going to talk about is quite popular in Australia, or has been quite popular and has probably changed in popularity in recent years, is a listed investment company. Again, very similar to managed funds and exchange traded funds. The difference is a listed investment company is a company. It's a PTY Ltd, a proprietary limited structure. That means the company pays tax, and it also means that these are closed-ended vehicles. So as we said, exchange-traded funds are open-ended in that new units are created every time someone invests. Listed investment companies essentially allocate and raise a certain amount of capital, and that capital is then fixed within that fund. This introduces the importance of a net tangible asset value, similar to a net asset value, in that because there's a limited amount of units, the demand and supply of those units means that your shares may trade at a premium or more than, or a discount, so less than the actual value of the underlying shares that they own. Popular examples in this case, and of course general advice only, AFIC, Australian Foundation, Argo Investments, as very large, well-established listed investment companies. So one of the benefits, again, is that you're able to get professional management and diversification. And in this case, they're actually able to smooth the returns and income. And this can be both a cost and a benefit. Because it's a company structure, these listed investment companies pay tax on the dividends that they receive, and thus have to announce their own dividend and pay their dividend themselves. Now, this can be beneficial. So during the pandemic and the GFC before that, these listed investment companies are able to continue paying dividends at the same level, even if the dividends they're receiving have reduced. This also means on the other side, the income can be capped. You could achieve a higher income by investing in a lot of these companies directly, but you're smoothing the ride by investing it into this structure. In terms of the biggest mistake or the biggest areas of risk that I see in investments, one is in unlisted assets, and this is not saying this is against certain parts of the asset class or not, but funds that invest in unlisted assets but offer liquidity. So the ability to redeem an investment that's invested in direct property, unlisted credit, and these type of asset classes. So it's always a mismatch between liquidity and access that we find is the biggest issue. And importantly, the biggest one I stress is tax-driven investments. Whenever you're investing, please ensure you're considering that investment from the perspective of what returns it has the potential to produce, rather than the tax benefits you're getting from it. In my experience, investing solely for tax purposes almost always ends up not necessarily in disaster, but in less than optimum outcomes. So just going through that again, we've gone through Australian listed shares, or just listed shares in general, managed funds, exchange traded funds, listed investment companies, and both unlisted and tax-driven assets. And as always, please send through any questions, any comments you have, any ideas around what other areas you'd like covered, and always follow and subscribe to this page.